Hello students, welcome to today's session on accounting ratio analysis. So students, let us understand, see in my earlier videos, I have already told you this ratio analysis or accounting ratio analysis is a very important tool for taking decision in the company for the growth of the company based on the accounting numbers or based on the facts and figures which are available. Okay, so understanding it from the scratch, we can say, how do we define this term accounting ratio? Accounting ratios are important tool of financial statement analysis. Now, when the number is calculated by referring to two accounting numbers derived from financial statements, this is termed as accounting ratio. Okay. So, I will write this here. Then, basis this, we can identify the main objectives of ratio analysis. The very first objective is to know the areas of business which need more attention. As I said, this is a very important management decision-making tool, right, for the future performance of the company. So the first thing which the company would like to know, which are its gray areas where it needs more attention, where it needs improvement. So this becomes the first objective of these ratio analysis. Then at the same time, the company would also want to know through ratio analysis the potential areas which can be improved with the effort in the desired direction. Then these ratios give a deeper analysis of the profitability, liquidity, solvency, and efficiency levels in the business. Then this also provides information for making cross-sectional analysis. That is, by comparing the performance with the best standard industry standards. And the last objective being to provide information derived from financial statements useful for making projections and estimates for the future. Okay. Now, so these objectives then give us or tell us about the or good side of the ratio analysis, and thus we have certain advantages of calculating these ratios. All right. So the advantages of ratio analysis, the first advantage is that it helps to understand the efficacy of decisions. Okay, that is based on these ratios, the company is able to understand whether the company is going into the right direction of operations or not, right? What kind of operations are going on, where all the company is investing, how much is the prospective profit or the potential profit the company is going to have in those areas of investment and the financial decisions. So overall, we can say that this is an indicator which helps us in improving, uh, in finding out the performance performance improvement in the company. Okay, yeah. Then just a moment. Let me just open my. Okay. No, the next advantage is simplifying the complex figures and establish relationships. Okay, so basically, again, as you would have seen, we make balance sheet, then profit and loss statements are made, cash flow statements are made, and in a glance, if we see, obviously, especially by a person who is a non-accounting person, this is all, you know, very complex thing. He would not understand which number is saying what, where is how to analyze those numbers, right? So these ratios make these numbers and figures quite simple to comprehend. Comprehension becomes easy through these ratios. Hence, even a non-accounting person sitting in the management of the company can understand the meaning and can take decision on the basis of those ratios. Then this is also very helpful in comparison. So ratios are not calculated only for 1 year, right? So again, when you keep many years such a ratio side by side, you are able to understand that, or you're able to find out that trend the company is showcasing. Based on that trend, now you can make projections for your future. Then the problem areas can also be identified. Okay. And then based on these numbers, the company can even conduct a SWOT analysis. Now, what is SWOT? SWOT is full form is strength, weakness, opportunity, and threat analysis, wherein strengths and weaknesses are the internal outcome of the company, which is reflecting, or which is seen in the form of these accounting numbers, these ratios, and then opportunities and threat lie in the external environment. So using these ratios and the trends which are following in the external environment, now company can find out where management can find out where their company is at this particular moment, and what all they have to do in order to make it further grow. Various other comparisons are also possible, right? So those comparisons we will be doing together when we do the questions. Now, then, as I said, advantages are there, but then these advantages don't come alone. Obviously, we have limitations also. Okay, so what are the limitations of accounting ratios? Let's see that as well. Okay, so limitations of accounting data we talk about. So, yeah, so the first ever limitation is that is, well, it follows the generally accepted accounting principles and conventions. Thus, what happens that these financial statements do not reveal or may not reveal the true state of affairs of enterprises, because they are only able to give you the results which the numbers show, right? Then whenever there is a price level change in the economy, that is also not reflected. Why? Because again, say the accounting ratios or the figures that are arrived here is based on money measurement principle. Now, because of that, when we are making the books of accounts, again, everything is measured in terms of money. So whatever is cannot be measured in terms of money will not be taken into cognizance in the books of accounts. This is one. Okay. Then secondly, we use the or the companies use historical cost over here, and that is sorry, sorry, students, there was a sudden call. Okay. So as I was saying that the when the accounts are prepared, historical costs are used for this purpose, and therefore cost which was incurred maybe few months back or in the beginning of the accounting year is recorded in the books of accounts. Now by the end of the year, the price levels would have changed in the market. But that change is not reflected here. So this price level changes are not or rather ignored in this case. Then qualitative and non-monetary aspect of the business is also ignored here, because everything is mentioned in monetary aspect, right? So qualitative aspects are ignored. Then accounting practices, there is variation in accounting practices. Different accounting policies are there for valuation of inventory, calculation of depreciation, treatment of intangible asset, etc. Right. So, and these variations cause a very big question mark on the cross-sectional analysis. Right. So, because of that, a valid comparison of the financial statement is not possible sometimes. And last but not the least, the forecasting for the future trends based on only on historical analysis is not a practical thing. So proper forecasting requires consideration of non-financial factors as well. So this was all about for today's session, students. I hope you all understood this topic. Keep practicing and I'll see you the next time. If you have any doubts, please contact me through my Urban Pro profile. Thank you.